So, somebody's interested in buying your business. Should you sell the assets or should you sell the shares? My name is Fabian, and today in this video, I'll be looking at the differences between a share sale and an asset sale, some of the key consideration and differentiator between the two, and hopefully this will help you assess which one is the best option for you, or get you a little bit of lay of the land to be able to have a more constructive discussion with your accountant. Alrighty. So the first question to ask is, who is doing the selling in a share sale? So let's look at this here first. Generally, this is a basic kind of organization chart for a small corporation. So you own some shares of your corporation, say 100 Class A shares, for example. So you're the sole owner of your corporation. You have your 100 Class A shares of the corporation, and the corporation in turns owns a bunch of assets, some cash, some inventory, some equipment, some property, and obviously the goodwill that you've built over the years. And it also has some liabilities. So it's got its trade payable, it's got income tax, GST, PST, WCB, it's got payroll related liabilities such as the remittances to CRA, vacation pay, severance pay, if your employees were to leave, and so on and so forth. You also have perhaps some loans or capital leases, and I'll come back to on loans in a little bit here. But this is the structure generally. So if you're doing a share sale, let me just get to this here. You are selling your corporation. So you're the one that's doing the selling, and what's being sold is the whole package of all the assets and all the liabilities. Simple. So let's go back in. Oops, that's not what I want. All right, so you are selling shares. If, on the other end, you're looking at an asset sale, the corporation is doing the selling, and the purchaser is cherry picking which assets it wants. So it might say, oh, I'll take the inventory, I'll take the equipment, I'll take the goodwill. I don't really care about the property. I'll move to another location. Or maybe there's no property, if it's a lease premise, then we're looking at that. So in an asset sale, the corporation is selling its assets, whether all of them or just some of them. So there's a fairly big difference there. In one case, as we discussed, the purchaser is buying everything, including liabilities. So that generally tends to, so you would go through an asset value to all your assets, but then you would deduct to arrive at the purchase price, but then you would deduct from that value of assets all of your value of your liabilities. So you would generally receive less money. So let's go generally lower purchase price or selling price in the case. Price because of liability. Another factor that impacts lower selling price is because let's think of equipment for example. So say you bought 5 years ago a big piece of equipment for $100,000. On the corporate tax return, that equipment would have gone in at $100,000, and then you get to write off a little bit of it every year. That's called the CCA, or capital cost allowance. So you get to write off a little bit of it. So there might be, say after 5 years, there might be, say, $50,000 of the value that's been written off and $50,000 left to go. If somebody's buying the shares of your corporation, they're buying everything. They're buying the history of corporate tax return. So this is where that unknown comes in, is if something has not been recorded on your financial statements, if CRA comes back and says, I'm auditing the corporations for 3 years back for something, and they found that something was not filed correctly, the new owners inherits all of those problems. And they also inherit the fact that the corporation had an asset worth $100,000. They're selling, it's worth 50,000 in terms of future write-off, and they're inheriting that. So even if the assets may be worth $75,000, or in some case maybe it's gone up in value as well, uh, even though they're willing to pay you more for that, they have to factor in that they're not going to be able to write that full value off. They're only going to be able to write off what was left in there. So though that impacts, they're going to be essentially paying more taxes compared to an asset sale. And so that impacts how much they're willing to pay you as well. So in an asset sale, because they're cherry picking all that they want, and they're not buying generally liabilities. I'm going to say that like in loosely, generally, like if they're buying in liabilities, they're also cherry picking any liabilities. And there might be some cases where that happens, like if you have gift cards, for example, or something like that. But they're very cherry picking about that. So generally higher selling price. All right. Let's look at the tax situation. So if you are buying the shares of if you are selling the shares of your corporations, how much did you pay for the shares? So this would be a capital gain. So it would be essentially how much you're selling the shares for minus how much you paid for the share, which is generally very minimal nominal value. So maybe $10, maybe $100. And then you pay capital gains on the difference to two. So capital gain on difference between proceeds and cost of shares. Now, you may have heard if you're a small business corporation and you have, you meet certain criteria in terms of length of ownerships and what kind of assets are in the corporation and so on and so forth, you may be able to use what's called a lifetime capital gain exemption. And this is something that's very attractive in theory, because what it allows you to do, and this is, by the way, for Canadian market, I should have said that at the beginning of the video, but we're talking about Canadian businesses here. So with lifetime capital gain exemption, as of the recording of this video in 2022, it's roughly $900,000 you can sell your corporation, the shares of your corporations for, without paying taxes or very minimal taxes. And that's actually an important point. So if you might hear somewhere that you can get away without paying any taxes. I'm going to say it's very minimal taxes. Talk to your accountant for more details, and we'll leave it at that for now. But very minimal taxes. So you essentially get even though you're getting a lower selling price, if you qualify for this lifetime capital gain exemption, you may be able to pay very little taxes. So most of the proceeds stays in your pocket. Excuse me. Whereas if you're buying or if you're selling the assets of your corporation, if your corporation is selling its assets, then the taxes would be kind of full general rate taxes. So even though you're selling for a higher price, you may be paying a little bit more tax as well. The inventory would be sold as inventory, so that's business income. Equipment and property would be sold as capital gain. So and there might be some recapture in there. So recapture is so let's go back to that equipment of you bought for $100,000. You depreciated it to $50,000. So you wrote off half of it. Say it's worth 75. Well, CRA will say your write-off of the equipment was more than what was the real economic life, because you're selling it for 75. So we're going to recapture tax you on the $25,000 difference. Just had to take a quick pause for a cat in my throat. All back there. So yeah, we're saying potentially higher taxes on sale of assets. So, but you're getting a higher selling price too. So the question ultimately, and I don't have the rule of thumb. Every restriction will be different. But the question is, how much more tax for how much more money? And do you get, which one is the better off for after tax in your pocket funds? I have to say, it's surprising how close the two get to each other in general. So it is worth talking to your accountant whether there's anything else that factors in. And talking of those other things that may factor in, uh, let's talk about this because it's not only income tax. If you are selling assets, you potentially have to charge GST. So if it's let's say inventory, equipment, property, all of those subject to GST. Inventory and equipment would also be subject to PST. You may have properties would be subject to property transfer tax, depending on the province where you live. Anything else that could be a factor in there? That's probably about it. Goodwill generally does not have GST, PST, or property transfer tax. So if you're a very lean business, or if you're a service business, for example, and you have maybe a little bit of computers, but for the most part you just have working capital and goodwill, and then your staff is the people that kind of generate the business there. Then maybe this is not so much of a point because you would have maybe on your printers and computers and so on and so forth, you would have a little bit of GST, PST, but the goodwill would be exempt for most of those. So that's one thing to factor in. The other factors that are we're looking at to look at is actually I'll go back on this side here. In the share sale, buyer would inherit unknown liabilities. I mentioned that before. They would also employee severance. So in terms of your employee, there's no change in their contract. They were hired by your corporation. The corporation as a new owner. From their perspective, nothing changes there. So they inherit like anything that has to do with severance, vacation pay, so on and so forth, which is often one of those unknown liability because if you have somebody that's got 10 years of services, Employment Standard Act will require that if they were to leave tomorrow, they're entitled severance and so on and so forth, or if they were to get laid off tomorrow. So that's one thing that's definitely a key point there. On an asset sale, as I said, there's tend to be a little bit more cherry picking of liabilities. This might be one of the places where there's more negotiation about of employment opportunity and liability taken on by buyer. So generally what you would see on an asset sale is there would be that would be part of the negotiation, but usually the buyer would sort of offer a new contract to all your employees, but whether they would take on vacation pay, that might be something that they kind of put forward. There generally would not be any new probation period or anything like that. So they would generally take on the severance, any severance liability for years of services. They would inherit those years of services. But that's something that, again, that might actually reduce your, that might be something that reduces the selling price on a share of sale of assets. That said, that would have the same impact on the share sale as well. So it's not like that's the place where they're cherry picking liabilities. If they have to assume liabilities, they'll factor in that on both sides, of whether it's a share sale or an asset sale. Anything else? Leases and loans, that's something to, if you have large loans or if you have leases of big pieces of equipment, something like that, make sure you contact your lender or the person, the party that's leasing you the assets. Make sure that can transfer over smoothly. Generally, that's not a big, if it's a bank and a loan, they might ask for new guarantees from the new purchaser and so on and so forth. But that should generally be a formality. If there's a red flag there, then usually potentially a red flag at your level as well as a seller. If you have leases, generally those ones can transfer as well, but I do encourage you to have a not assume that. I've seen actually a couple exceptions to that where the leasing company just said, no, you have to buy out the lease if you want to, and then the assets is yours and you can do whatever you want. But buying out a lease is actually very punitive and is expensive. So make sure you're not in a situation where that's applicable. And I would actually say, like, even more so if you're somebody who's contemplating selling their business in the next 5 to 10 years, and you're looking at signing up into a lease for somewhere around those terms, or purchasing a piece of equipment around for with financing around those terms, I would generally kind of lean towards a loan as a rule of thumb than a lease, just because a loan is a little bit more straightforward in terms of, if you're doing an asset sale, you just get the proceeds, you pay off the loan, everybody's happy. If you're doing a share sale, they just inherit the loans, and short of papering the change of ownership, usually the bank is relatively happy. But on the lease, there's a little bit more moving parts sometimes, and that can be a little bit more tricky. Anything else? I think that summarize the main consideration here. So I believe I will leave it at that. If you have any question, don't hesitate to reach out, and hopefully this was a helpful video. Take care.